Good afternoon. My name is David Jarvis, and I'm President, CEO, and founder of Corton Capital. Corton Capital is an asset management firm that specializes in traditional investments and alternative investments. Our goal is to create comprehensive portfolios for investors by marrying up both traditional and alternative investments for you. What follows next are a series of presentations and comments by various managers within the Corton family discussing the performance and successes that they've experienced with the funds that are carried within the Corton family. I hope you find it informative and we look forward to working with you. We are here to work with you and create comprehensive and interesting portfolios for you. Thank you very much.
Hey, welcome everyone to the monthly Corton-Aemelia Quant Fund podcast, where we try to take the emotion out of investing. Harder than ever these days, it seems, with all the massive gyrations we're seeing in the market, but we'll do our best. So firstly, our fund disclosures. I'm Mark Deriet. I'm the founder of Amelia Capital Management Corp., an independent firm that develops quantitative models that have been licensed to and implemented by Corton Capital, Inc. Corton is the investment fund manager and portfolio manager of the Corton-Aemelia Quantitative Fund and its underlying fund, Corton-Aemelia Quantitative Fund LP, each a related issuer of Corton. This is my usual mugshot with my history in the business. Been around for 30 years, but it doesn't seem to get any easier. I take it one day at a time, I always say. Our red light, green lights, lots of red lights. So had we looked a couple of months ago, there were a lot of red lights and quickly reverted back to green, which is not the norm. It was a very quick drawdown of about 9% on the S&P and an equally fast recovery. These V-bottoms seem to be happening more frequently these days, but we'll try to follow indicators and lots of green lights. There are, some things that are getting stretched, and we probably need to spend some time backing and filling. But we, again, will take it one day at a time. So the S&P, this momentum indicator at the bottom, which is a weekly RSI, they call it, just basically oscillates from 0 to 100. Very quick sell signal. We use below 40 as a sell. And then when it's able to break above 60, that's a buy signal. Very, very brief period in the sell zone. You can see, going back to 2022, it spent many months in a sell before it got back into gear. So, you never know what the market brings, but we did hold an important line in the sand for us. This red line is an 80-week or roughly 20-month moving average. And when that tends to hold, that's kind of our cyclical bull line in the sand. You can see during the tariff tantrum, it broke and then quickly recovered. I don't have the line to show you here, but the 200-week is what caught the support back here. Also, the 200-week held in October of 2022. That's not shown either. But you can see on the next slide, this red line, the 20-month moving average, has only been broken 10 times since the mid-1990s, whereas the dashed green line is the more popular 200-day, and that can give many false whipsaws along the way. So we like that 80-week as the line in the sand, and again, we made a stand there and held. This is the global equally weighted index of about 3,000 stocks, and there's a lot of talk about narrow market and so on, which some indicators would agree with. So we're looking for this to break out to new highs to confirm the S&P, but it's not as if this chart is in a downtrend. So the average stock is actually testing its highs. It just hasn't quite made a new high, so it's been lagging a bit. We had what's called a follow-through day on April the 8th, and this is a concept by a man named Bill O'Neill. He passed away last year, unfortunately. He was a famous investor and founder of the Investor's Business Daily. And this is just a setup that he came up with to catch bottoms, and the blue lines show when they happen. You can get whipsaws, and it can be early in a more significant downtrend. But it's a good way to catch these V bottoms. You can see on average, those follow-through days happen 6 days after the low, and you give up on average 5%. And again, we got it April 8th. Did we know that the market was going to go straight up? Absolutely not, but that's what happened. And then we got a momentum thrust. So this is looking at a 13-day rate of change that's north of 9%, which is 2.5 deviations versus the mean. It's another way to try to confirm a low. And then we see the table here, the history of these momentum thrusts have about a 75% hit rate. No indicator is golden, unfortunately. And I put arrows beside the times where it didn't work. One time, for instance, was March of 2000. We had this blow off top in the market where it just accelerated and it all fell apart. Or another more recent time was March of 2022 when it was too early. We had a big thrust up off the lows, but the market came in and made new lows. So nothing's perfect, but this momentum thrust is one thing that the bulls can put in their quiver. What's lacking, a piece of evidence for the bulls, is what's called a breadth thrust. So we look at 12 different thrust indicators, which are all in the small table at the bottom with some descriptions. And the red bars show how many of those 12 have fired at any given time. And 0 so far have fired off this recent bottom. Whereas normally we get more than a third coming off a major low. Now, this wasn't a bear market. It was more of a garden variety correction. So maybe you don't need a breadth thrust, but it is notable that this is lacking in this recent upturn. One of those indicators was developed by a guy named Jeff DeGraff. Renmac is his firm in the US. He's the #1 voted technician down there. And he studied 4-week highs when they exceed 54% of the S&P. So we didn't quite get that. We got around 45 or so, these green bars. So we didn't get this escape velocity, he calls it, which gives you generally about a year of good times ahead. So we'd like to see that. Hasn't happened yet. And then just the percent of stocks above their 20-day on the left or above their 50-day on the right. They usually zoom all the way up north of 90% when you get a big thrust, and that hasn't happened either. There's only half the stocks in the S&P above their 50-day, despite the S&P making new highs, which is a little bit odd. And here we look at the percent above the 200-day, just zooming out a little bit longer. 56% are above their 200-day. Again, a little bit odd to have only about half the stocks in an uptrend. The good news is that this indicator bent. It didn't break. So we look at 40% as the line in the sand where there's too much damage underneath the hood. And you can see during this corrective phase that didn't happen. It didn't break below 40. If you do, the odds are very high that you go all the way down to sub 15, where you get this blood in the streets zone, we call it. And that's sort of a washout. And typically when that happens, it's a good time to buy. Another indicator that bent and didn't break are the red bars here, which show for the Russell 3000 how many stocks are making 52-week lows. So when that exceeds 10%, that's our warning sign. You can see we've circled in yellow the prior warning signs. And that, again, bent and didn't break. A couple more breadth indicators here are not really expanding. You can see the longer term ones on the left for the S&P. So this just measures how many are in a longer term uptrend, and it bottomed at 56%, but it's only 57.6% now, despite the fact that the S&P is powering ahead to new highs. So we know it's been driven by this AI, semis theme and so on, and they're carrying the weight. But only just over a half of stocks are in long-term uptrends. We also look at the number of stocks in Canada. Green bars are making 3-month highs and red bars 3-month lows. So the blue line shows the spread between the two, and it's a 10-day average. So when the blue line is above 0, the market is fairly healthy. The internals of the market are constructive. You're making more highs versus lows. And that flipped positive here several weeks ago, and it remains positive. So every day we're going through this list of stocks. These are the ones that are closest to their 3-month highs and looking for ideas. Things that are starting to turn around or breaking out of base patterns and so on. So it's a very simple thing we do. We look at lows as well for short ideas. This is where we get a lot of our ideas for our research from. We have a tactical indicator here. I call it a baker's dozen because there's 13 of them all rolled into one. And this got very, very depressed during the correction. And it zoomed back up here and it's close to getting overbought. So, maybe we get some backing and filling after this big run. A sentiment gauge. This is a CNN fear greed index in blue and the S&P in red. It's not yet too stretched, so possibly people can get more exuberant. And then the bull-bear spread also, there's actually more bears than bulls still, which, typically when we're at the end of a long bull run, everyone's very, very positive, and this red bar exceeds 20. Volatility has settled back down, which is a good sign. This is volatility for stocks, bonds, and currencies. You can see the quick spike up and the quick drawdown. So a quiet market is a healthy market, and a noisy market is a bear. We don't like the noisy markets. Credit spreads, which are in the red line, inverted. So when this red line is going down, credit spreads are widening. The bond market is becoming cautious. And often you get a warning sign where the equity market in blue peaks after the fact, after the credit people have kind of sniffed out the problems. But you can see the last 2 times were kind of Trump-induced. They're exogenous events, and they both fell at the same time. Now we're seeing credit spreads tighten, that red line going up. So credit has settled down as well. Commodity breadth in blue has really spiked here recently, and it tends to correlate well with economic indicators such as the red bar, or the red line here, which is the US PMI. And you can see they're both kind of coming out of their funk. They were stuck in ranges for about 3 years and not yet at exuberant stages either. So in the spring of 2021, all these indicators were as good as they can get. Everyone was excited. The PMI made a record high, and that was the time to sell. So we're not there yet. There's possibility for a further economic expansion ahead. In terms of sorting commodities from strength to weakness, energy is not surprising at the top, but it's quite stretched. So we have a normalized 26-week rate of change, which is just a momentum indicator, and they're quite hot here at more than 3 deviations. The longer term 2-year rate of change is not yet too hot. This is the CRB Raw Industrials Index. It has things that are used in the real economy, such as scrap steel and rubber and so on. And it's broken out of a 3-year base, and it's right near the high. So this is a good global growth proxy. If it were to fall, then we'd be talking a recession. But the good news is it's holding up quite well. Oil has been in this pretty sloppy range, frankly. We're back above 100 today. Really, it's kind of 85 to 110 if you lop off the extremes that we're trading in this range. It's kind of a tough call now. We were constructive on the energy sector way back here. And now it's, day by day, to be quite frank. So the volatility has really picked up for oil, which just makes it a more risky environment. We like the setup of copper versus gold, which we've been talking about for a while. The red line is the ratio of copper to gold, and that's starting to move in favor of copper. The blue line is that PMI, that leading economic indicator for the US. And you can see the big alligator jaws that have opened up between those 2 charts. And the copper to gold stocks on the right have started to mean revert back in favor of copper stocks. They're about 25% off the bottom after having a drawdown of about 70% on a relative basis. And the price of copper never went parabolic like silver and gold, and we get about $8 off of that base for copper. 10-year yield is in a long-term uptrend now. So it had this washout during COVID. The low was around 32 basis points. And in the mid of 2022, this momentum indicator, this is a quarterly chart, a quarterly RSI, flipped positive by going above 60 for the first time since falling below 40 in 1985. That's a long downtrend that's reversed. And you can see we've just been kind of consolidating in time rather than correcting in price, which is a sign of strength. So we're looking for this to break out to the upside, which could weigh on growth stocks in general and the market in general in terms of the valuation. The 2-year yield in blue and the Fed funds in red. So you can see that blue line has flipped back above the red. So the market dictates rates, not the Fed. And we can see that now we're looking for potentially a hike rather than a cut. The good news is that when you start a rate cutting cycle, there's about a 50% chance, 4 to the 8 times since the mid 1980s, that you've had a recession. And when you get a recession, the 2-year yield collapses. So the blue line really falls aggressively. That didn't happen this time. So it looks like we've averted a recession. And on that recession idea, we like this blue line, which is the Fed Weekly Economic Index. It has hard data in it, they call it, like gasoline sales, and electricity usage, and retail sales, and so on. So this never indicated a recession, whereas how people felt, the sentiment surveys, the PMI and the Conference Board leading indicator, called for a recession in the middle of 22, and we're still waiting for Godot. So it's the first time that these indicators kind of broke down and gave a false signal, but basically what people were feeling versus what they're doing were two different things. And what they're doing is still saying no recession. And this shows beta versus quality in red versus the PMI in blue. And again, there's possible room for expansion in the blue line and possible room for beta to continue to outperform quality. No recession based on this labor market indicator as well. This rolls in 8 indicators into one line. And you can see it's actually starting to stabilize now. We were so tight post-COVID. And the good news is we cooled, we didn't collapse. So you can see a recession, these red lines, when that indicator falls aggressively. Our Baker's dozen of risk trades has quickly recovered to new highs, as has cyclicals relative to defense. That broke out to new highs as well. So the shift back into offense is upon us. In terms of our sector heat map, energy is at the top of the pack in terms of the long-term momentum score. That maps out with the x-axis on this sun rain chart. And the short term is the y-axis. So energy's peeling off a bit, but still pretty strong. Golds are number 2 on that long-term list, but fairly weak short-term. So the idea is you tend to rotate around clockwise. And what's percolating are REITs for the first time in quite some time. The long-term is still weak, but the short-term has improved, and technology as well. This is an important slide to me. It's the ratio of global energy and financials, kind of short duration stocks or value stocks versus long duration or growth stocks, tech and healthcare in the denominator. So energy and financials versus tech and healthcare. And notice that low at the COVID lows when rates bottomed. And ever since, this ratio has been grinding higher. So this is kind of the new game in town that's happening underneath the hood, confirming what's going on in the bond market, higher rates, in other words. So we just show here some of our screens, our sun rain chart for the top 100. So, we're looking for the guys that are coming out of this rain cloud that have been there for a long time. So we've been adding to some of these names that are percolating in the improving box. And we're concerned with the stocks that are in the lower right quadrant that are weakening, a lot of gold stocks there. And just some other screens, our quantitative models are here, strong on big caps on the left and small to big caps on the right. And in terms of our performance, so we're up about 29% for the F class of the fund. The good news is that the beta, that's a much smoother ride. So the beta is 0.52 since inception. So the fund has lagged the market a bit, but with a much lower volatility. So that's kind of our goal. Obviously, we'd like to keep up with the market, but has been quite volatile of late, obviously. And we want to deliver a more steady stream of returns, essentially. The top contributors last month were Hammond Power, Enerflex, and Wolf, which is a data center play, and the biggest contractors were AGF, Celestica, and MDA. So that's all we've got for you this month. If you're interested in the fund, you can reach out to David Jarvis. The PM and IFM is Corton Capital. And thanks a lot for your support. Talk to you soon.